The PE ratio is 12.5, the price to book is 3.2, and the year-over-year revenue growth is 14%. And yet, I am not investing in Skyworks Solutions. I will share what is holding me back in this video. Alright, let me start by analyzing the income statement. The revenue this time around was $1.3 billion compared to last quarter's record $1.5 billion. Still, that is 14% higher than last year's numbers, so the top line is still healthy. Management has reported that the revenue was driven primarily by the automotive segment of Silicon Labs that Skyworks acquired in 2021. That is very good news. Skyworks has made an acquisition that is contributing to their top line. The cost of revenue has also gone up. The net result is growing gross profit and strong gross margin. At 50%, Skyworks' gross margin is evidence of a strong business model in the 5G market space. The total expenses have been trending up, driven largely by growing R&D investment at $161 million and sales and general admin at $83 million. After taking away the total expenses from the gross profit, the operating income came in at $367 million. The operating income has dropped heavily from the record $517 million they achieved in 2020 and has dropped to 2017 levels. The operating margin has been trending down and has dropped to 27.5%. The net profit has also dropped to previous levels, and the net margin has been sliding down to 22.9%, but it is still a decent operating and net margin. The earnings per share has dropped from 240 to 186, but is still holding up compared to the 150 levels achieved in 2018. Looking at the valuations, the PE ratio is at 12.57 at the current price of 103. The PEG ratio is 0.9 due to the 14% year-over-year revenue growth. Next, let's take a look at the cash flow statement. Since this is the Q2 report, the cash flow is reported for the last 6 months. I have recalculated the numbers for the last 3 months that show the most recent quarter's performance. Also, we are only interested in a few key numbers from this report: the operating cash flow, capital expenditures, and the amounts used for the repurchase of stocks. The operating cash flow has dropped heavily from $582 million achieved in the same quarter last year to $393 million. The drop is mainly due to the movement in working capital. At the same time, the capital expenditures have increased to $127 million. The drop in operating cash flow and rise in capital expenditure have resulted in an even bigger drop in free cash flow from $486 million to $266 million. There is also a net cash outflow in financing activities of $496 million due to stock repurchase and dividend payout. This has resulted in an overall net cash outflow of $200 million. Skyworks' cash position is slowly weakening. This is evidenced by a quick ratio of 0.94. We are all wiser in hindsight, and looking back at the amount of share repurchase and the price Skyworks paid between January and April of 2022, we can only look back at how much Skyworks has lost with the stock repurchase. Skyworks bought the shares at between $156 and $128 for a total of $421 million. At the current price of $103, the current value of those shares is $313 million, a deficit of $107 million. Skyworks has been giving out dividends since 2015 and has been increasing year over year. It has almost doubled from the $50 million they paid in 2015. The balance sheet is healthy with real assets such as property, plant and equipment, and cash. There are also large portions of goodwill and intangible assets. On the liability side, the biggest item is long-term debt at $2.2 billion or 25.7% of total assets, and Skyworks paid interest of $11 million or 2.8% of net income. The debt levels are well within the norm and there are no issues here. Fundamentally, Skyworks is a solid business in the 5G market space with diversified products in the automotive industry. It is well within the valuations at a PE of 12.57 and price to book of 3.22. So why am I still apprehensive about investing in it? Let's take a look at the technical analysis to answer that question. The price has dropped from the highs of 200 to the current 103, and the price drop has accelerated in recent times with a break of the lower trend channel to the downside. This is usually a bad sign as it looks like investors are fleeing the counter. It could also be a sign of overselling that presents a good buying opportunity. But it is risky to invest at this juncture as it could continue to fall further. Investing against the trend is one of the worst investing strategies. It is safer to wait for the price to stabilize and show clear signs of a turnaround before investing. Skyworks is a solid company and the price will eventually turn around to hit new highs. There is still plenty of upside. I don't see any need to hurry and take any unnecessary risk at this point. Hope you have enjoyed this sharing. Let me know your thoughts in the comment section below and have a profitable week ahead.